Welcome to this video on navigating 2026 strategies to maximize your mutual fund returns in a high-value economy. We will focus on lump sum versus systematic transfer plan, or STP. The 2026 market outlook is defined by growth resilience and high equity valuations. The focus is shifting from simple entry to strategic deployment, supported by a stable interest rate environment, digital economy dominance, and infrastructure spending. The investment dilemma involves balancing immediate exposure versus mitigating risk. Lump sum is best for high-conviction, undervalued market phases. STP is a bridge from debt to equity, mitigating the risk of poor timing in volatile markets. Risk management is the primary challenge for the 2026 retail investor. The power of lump sum is based on the principle of time and market over timing, due to the compounding of early gains. Historically, a 10-year holding period favors lump sum. We recommend deploying lump sum during corrections exceeding 5% in 2026. STP offers tactical precision. Capital is initially parked in a low-risk liquid fund. A fixed portion is then transferred monthly to the equity fund, minimizing the risk of poor market timing through rupee cost averaging. Looking at 2026 market volatility trends, the projected volatility index suggests higher swings in the third and fourth quarters of the year. Expected returns benchmarking shows that lump sum in a bull phase yields 14.5%, STP in stable phase yields 12.8%, and STP in a volatile phase yields 11.2%. The liquid fund default is 6.5%. The efficiency matrix for tax and cost shows differences between lump sum and STP. Capital gains tax is applied at redemption for lump sum, but on each transfer for STP. Lump sum has a high market timing risk, while STP risk is low and averaged. Lump sum is one-time and operationally simple, while STP requires periodic monitoring and recursive checks for exit load complexity. Our 2026 sector recommendations prioritize technology and AI at 35%, green energy at 25%, and both banking and finance and consumption at 20%. The 12-month roadmap suggests parking total capital in a liquid fund initially, followed by fixed STP transfers of 10% per month for 6 months. Month 7 involves portfolio rebalancing review, leading to a complete transition to equity by months 8 through 12. The verdict for the high valuation market of 2026 is that STP offers the optimal risk-adjusted path for capital exceeding $50,000, while lump sum remains the best for long-term thematic satellite holdings.